Welcome to the Corporate Treasury 101 podcast. In today's episode, we discuss digital assets in Treasury with Noah Herman from Fortris. Noah is the Chief Revenue Officer at Fortris, who brings a wealth of experience from his role as the former Director of Treasury Services at Circle, a leading blockchain-focused financial services company. Fortris is a treasury operations platform that connects to your existing systems and gives you the ability to use digital assets in your day-to-day business. In the episode of today, expect to learn what are digital assets and how have they evolved since the creation of Fortris in 2017, how companies can diversify their treasury operations using Bitcoin and other digital assets, what is trapped cash and how do digital assets address this issue, how can anyone ensure liquidity and stability when addressing trapped cash challenges? And like always, much more. Another amazing interview with another amazing guest. Noah is extremely knowledgeable about digital assets and treasury, which made this episode particularly insightful for Hussam and I. We hope you will enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us and help more people learn about treasury. On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101. And with all that being said, please welcome Noah Herman. Noah, thank you so much for coming on the show. Obviously, we discussed a bit before this episode, so I had to Google a few terms. But for the part of our audience that, like me, didn't know exactly what it meant, can you please start by explaining what a digital asset is, please?
Sure. So yes, the term digital asset is used very widely. It's used to cover, as you've noted, a lot of different concepts, a lot of different assets, a lot of different currencies. Ultimately, the simplest way to talk about a digital asset is just as a on-chain reflection of its fiat mimic, right? So stable coin, digital dollar, simplest concept. You take a US dollar, you take a euro, you take a whatever currency you want, you stick that euro or dollar in a bank. In the meantime, a group says we are minting or on-ramping a digital variant of that dollar that sits on chain, looks, smells, feels exactly like that same underlying US dollar, euro, but it's sitting in a digital asset custodial setup. And from there, you can really run the gamut from something like the original Bitcoin, which has a lot of different components to it, a lot of different security features, different protocol chain, but ultimately it's just a different digital asset. And then you start to get into some of the more esoteric versions of digital assets, which can be things like Ethereum, can be things like ERC20, so-called derivatives. You can get into things like NFTs and wrap tokens, so on and on and on. But the simplest description is it is the on-chain or digital version of a fiat or traditional asset.
Okay. And by on-chain, you mean in the blockchain, right? Or using the blockchain technology behind it. Sorry, it's going to be very digital asset 101 here.
Absolutely. And I apologize. I try to stay away from all forms of verbiage and crypto speak. So yes, on-chain is just a simple way to refer to the fact that, yes, in order to have or use or operate on a digital asset, it needs to be done on the blockchain, which is the distributed ledger technology that forms all blockchains and protocols. And we say in the world of digital assets on chain, just to refer to the fact that essentially, regardless of the chain, regardless of the protocol, you are really taking an asset, again, whether it's a simple reflection of a physical asset, say a listed bond or something like this. You are making a data recording of that within the respective protocol, and that is being locked into the chain of blocks, literally, that is forming the then immutable proof and immutable records for that transaction.
Okay, so to take a very basic example of what my understanding is, the digital version of a banknote, like $1 banknote, the digital version of this will be the $1 that is displaying on my bank account when I look at my app. The digital asset version of this is exactly the same reflection, but on the blockchain. Would that be a simplistic yet correct enough?
It's as simple and accurate as you can get. It's exactly right. And ultimately, when you look at it, it's really just all about ledgers, right? So to your point, if you're using HSBC, there's your mobile phone, there's my €1, my £1, my $1. That is itself sitting on a ledger within the bank. The bank controls it. You need the bank to get it back. Custody of the bank, right? Only difference, to your point, being just a different ledger, which is the on-chain protocol.
Super clear.
So it was really interesting the way that you described it. So you're saying that digital asset isn't just crypto related. It's just any digital version of real money. Is that what you're saying?
I think that is probably the most accurate and capacious way to describe it, but it is, especially today, an important way to do it. You're correct. The world of so-called digital assets started out much more with Bitcoin and stablecoins, right? Well, so truly the first reference to digital assets or digitizing assets was, to your point, mobile banking, right? People said, oh, wow, now I can just add money without walking into the bank and taking $1 and handing it to my friend. So yes, that is the digitization, or the first step of digitizing what was otherwise a paper fiat predominantly. The second rendition, though, of that, which has happened in the past couple of years and is especially happening now with a bit more frequency as it relates to real world assets, is the notion that, yes, you can, much like we started talking about, take a simple dollar and create an on-chain version of it. You can also take a bond. You can take, I shouldn't say can, groups are and have been now to some volume, taking pieces of art and saying that this piece of art is worth $100. So we'll split it up and each dollar's worth of 100 can be represented on the chain. So yes, it can be bottles of wine. It can be ownership in real estate. It really can be anything. The true sort of umbrella is that anything that is a true digital asset in the world of cryptography, if you want to, will sit within a distributed ledger.
I love that. So to go a little bit deeper into definition, because we're going to get into the nitty-gritty on how digital asset can help, and is already helping treasury tasks, but just to completely understand what we're talking about. If you would compare a digital asset to a traditional asset, to take like basic definition of it, how does it differ then from my mobile application or in the uses that you see? What's the difference?
Sure. So again, we'll limit this to just sort of the simplistic use cases.
Yes.
So the only difference really, again, comes down to the way that the data is translated, right? So in the case of the mobile banking example, you are going to the bank and you're moving $1, right? And that is fast, it's easy, you're just clicking it and the dollar goes right to Guillaume, and wow, he says, I got it on, Venmo or Zelle or whatever it is, In reality, behind the scenes, there's an extremely complicated and lengthy and time-consuming collection of groups, intermediaries, third parties, which can be anything from SWIFT to FedNow, to central banks, correspondent banks, to domestic banks, to regional correspondent banks, to third-party payment providers, to the rails behind SWIFT, to your credit card company. There's many, many thousands of things going on. So in effect, though it is a nice step change, and you are able to, in fact, move that dollar quickly between you and Guillaume, in reality, that's not happening behind the scenes. So that is the way that you move a dollar still today, despite the mobile banking interface and UI being nice and easy. If you do this in the world of digital assets using distributed ledger, what's happening is largely the same human action, right? Largely the same UI. You still have your same phone, and you are still, in fact, sending a dollar to Guillaume. But when you do that, you are now simply sending that same dollar, maybe in the form of a stable coin, call it USDC, which is a widely known stable coin. And that is involving precisely zero of all of those 30 parties you mentioned earlier. It is using just one thing, which is the distributed ledger, that stable coin, and your two wallets. And so it seems to happen at the same speed, seems to happen for the same cost to you ostensibly as a consumer, but in reality, you've essentially taken all that undergirding and thrown it out.
Super clear. Just for the sake of it, stable coin. What do you mean with that, Noah?
Yep.
Let's just assume that we don't know all the aspects of it.
So the concept of the simplest form of a digital asset being a mimic of a government fiat currency, right? So in this case, U.S. dollar, still the most widely traded currency. So we'll reference that. It's not because I'm American. So the U.S. dollar has a couple of different representations in the world of digital, the world of distributed ledger and crypto. But the simplest one is to take an example, either USDC, which is U.S. dollar coin, or USDT, which is another example. It's called Tether. And there are many others. They're all doing the same thing, in effect, which is that they are using that same process we referenced before to take a fiat dollar and create a digital representation of that dollar on chain. They were born into the world 10 years ago as a so-called stable coin because they were trying to keep all of the technological advancements that were there with Bitcoin as a distributed asset, decentralized asset, but do away with what was one of its biggest problems, which we've spoken about quite a bit already earlier, which is the volatility, which to quote my old head of policy could make some hedge fund managers blush. And so the stable coin literally was meant to create stability in the currency. Okay. And as we know it, the most, or at least as financial markets know it, the most stable currency in the world is US dollar. And so that's the term. It has variously been referenced now as the digital dollar versus the stable coin. And that was not just because at some point one of these has depegged from the dollar, but that's another story.
Okay, that starts getting very complicated if you have a US tether that's not tethered to the US dollar. So we can get into that in a second as well. But so I want you to explain a little bit more about why someone would use the stable coin versus the actual asset itself. But I think to explain that, you need to explain a bit better what the chain is and why the chain has any advantage over traditional forms of asset management, managed money management, or money movements.
Yep. So yes. So the answer is many-fold, but a good caveat to all of the answers is sort of the opinion of both sides, right? One is you have this camp on one side of the world, which says that all digital assets, but specifically stablecoins, are a solution looking for a problem. meaning that there's a certain advancement in technology, there's proven value in it, and that value usually comes down to savings in time, in cost, and operational complexity. Those are usually the three pieces that are cited, which are significant and real issues for any business today. You have another camp on the other side, which says the fiat world is untrustworthy. Governments all around are inflating their currencies. We as citizens of those countries have no control over those currencies or governments. We don't like it, and we want to be able to have some control over our monetary system, and then anything in between. Somewhere in the middle lies the truth, is my theory and thesis. And from all of the conversations we have as a company, I think it's fair enough to say we have a variegated range of data points, statistical, informal statistical surveys. So the short answer is then, to answer your question, Guillaume, generally speaking, if you're a person, let's say in the same country, so if you and Guillaume are in the US, there is not a lot of benefit necessarily, or I should say difference from existing technologies as to whether you want to use Venmo, PayPal, Zelle, whatever it is, to send instant payments. It is when you step out of that country, when you now are sitting on two different sides of an ocean, which is not often the case for two friends, two colleagues, right? Yes, maybe friends are borrowing money from one another, and then one's in Portugal, one's in Africa, they need to send some funds, fine. It's not a true volume play, though. That is when you get into the realm of business versus retail. And therein lies the true, let's call it sea change benefits to using a digital asset. And back to your original question, which is, it is, to this day, extremely costly, very slow, and extremely complex to move money around the world. And using the distributed ledger, using chain protocol, and using digital assets as a way to effectively, if not almost completely, reduce all of those issues away.
So it's simplifying cross-border payments, essentially, because, yes, on your app, you just see, hey, I transferred money to my friend in Africa, but behind the scenes, a lot's happening.
We tend to look at it through the lens of, from my SAP dashboard, from my NetSuite Oracle dashboard, or from my Kyriba dashboard, because we are ultimately working with other businesses. Now, those businesses themselves are receiving funds from and paying out to customers, retail. But yes, that is, I would say that's accurate.
So can you explain a bit more of the chain then, though? What is the mechanism behind it? I think most treasurers have at least a pretty good fundamental understanding. Okay, when I know when I make a bank transfer, it's not just simple as my bank account there and then it's there, right? We understand that there is SWIFT behind that. We understand what's behind that. We understand that these banks have reconciliations that they do between each other and all this kind of things, right? Now, we've done payment rail episodes as well, episodes on the Corporate Treasury One podcast, not for digital assets. So can you explain the chain and how money moves and why it's simpler?
Sure. So the simplest way to talk about it is, you can think about a business as just a collection of people, right? You can even think about a standard business transaction as a form of ultimately what is the same example we gave, which is you've got a friend in Portugal, you've got a friend in Africa. From the business perspective, it's the same conversation, right? That friend sitting in Portugal who needs to get money to that friend in Africa can just be extrapolated up by an order of magnitude to, you are a multinational corporation and you are headquartered in Portugal, and your primary bank, I don't know any of the primary banks in Portugal, but let's just HSBC, is there. What is the name?
There's a Nova?
Novo Banco, indeed, that's the only one we know.
Novo Banco. Okay, so your primary financial institution for your multinational is Novo Banco in Portugal, and you have multiple subsidiaries around the world. One of them is in Africa, and that bank is not Novo Banco. It's whatever bank that is, Standard Chartered. Rather than running through, as you said, all of the traditional rails behind that, you essentially have the same structure with the business transaction, which is that the headquarter company has a wallet. So now it has nothing to do with Novo Banco. It's actually the corporate itself. Let's call it Acme. So Acme has a parent corporate digital asset wallet that it holds. And when it needs to send its 100 million euro to Africa, it clicks through to its African subsidiary wallet on its interface, whatever interface that is, and says, I want to move 100 million euro to Africa. And that can be done by either just so-called on-ramping from the euro currency into a stable coin, into Bitcoin, whatever it is. Type in the amount into the interface, and that data, that transaction is then instantly recorded on chain, logged in an immutable fashion on chain. And those assets are then moved on the ledger, that is the distributed ledger, versus the bank's ledger, from the headquarters in Portugal to the subsidiary Africa. And now, a couple of milliseconds later, the subsidiary in Africa is sitting on 100 million euro equivalent, whatever is the local currency, Naira, call it, at which point they can either off-ramp back down into their local currency, or they can keep that in their wallet for local treasury operations. So it's effectively one or several people controlling the transaction, all within the corporate, signing off on its movement. It's the two wallets, and it's the on-chain transaction which have facilitated the entire movement of that same 100 million. No reconciliation has been involved because the money and the message are moving at the same time, all being embedded in the blockchain. It's cost the group very little because it's just the mining fees to move that sum of. We can talk later about what that means, but basically just the cost of the transaction is minimal. And obviously it's happened in milliseconds. So that is the business example. And again, if you think about any business over a certain size, that happens multiple hundreds of times per day.
Okay. So the example that you gave there, right, was kind of that you don't have any external nodes, and then you have all your nodes internal. So my understanding of what blockchain is that the distributed ledger that you mentioned there, and correct my definitions, and then if I say anything that's incorrect here. My understanding of what the distributed ledger that you mentioned a few times is, you have lots of different computers set up, all of which are live connected to each other on the internet, right? And they all have, through this technology called cryptography, right? And this encrypted ledger, essentially, of transactions. It's just money moved from A to B, money moved from A to B to C to D to F, and it ended in G. Did I miss the letter?
Yeah, that was correct, I think.
And so everyone has access to the same ledger here, right? That does that. So the benefit of the chain, typically, as it was said, and I'm a little bit more talking to the individual, and I really want to bring the focus on the business, is this decentralization that, okay, everyone has transparency, everyone sees what's happening, not one person can manipulate everything, there's not one single point of failure. If one node goes offline, you have all the other ones that are still available, so money can still move through a different sequence. It maybe skips F and then goes to Z and then back to G, right? And so that's kind of what the idea of the nodes system is, a distributed ledger, right? So I think to a treasurer listening though, like if they hear, hey, okay, so I need to convert from euro to another currency and then back to another currency again, right? I add one more FX in my process.
Through many different computers. Like as a treasurer, you might think, okay, but my data and my money is everywhere then. Taking it in very simple terms, Noah, but...
So we're going to start pushing back on you now, Noah. Now that we've just a little bit, we'll go through, okay, because there's resistance to this, right? Overall. So what will be the resistance? You tell us why we're wrong.
Absolutely. And you know what? It's a very, very good point. And it's one that has caused some serious problems for, among other companies, groups like Circle, for example, which have promulgated USDC as its stablecoin, which on the theoretical level is almost a perfect asset. It can be used anywhere. It's a mimic of the US dollar, which is the most heavily traded currency in the world, right? It's trusted, it's liquid, almost a perfect asset on the theoretical level. But on the practical level, not so much, for exactly the reasons you're talking about, which is, if we have a transaction again where we bring it back down to Hussam and Guillaume, this time Hussam, you're in the US. And Guillaume, you're walking around in the middle of a field somewhere in Nigeria for whatever reason.
I love Nigeria. It's perfect.
I do that in past conversations. You say, Hussam, I need that dollar. And he says, oh, no problem. And there goes the USDC over to you. And you say, fantastic. Now, let me just walk to my local bank here and off-ramp this thing. Oh, wait, there's no bank to be seen for miles, right? That's a problem. So that is what in any industry, but certainly even in this one, meaning the crypto industry, is called the last mile problem. And indeed, it is a problem for everyone. It's a problem for Circle Proper, which is a very, very neat engagement with a group called MoneyGram, which everyone will know. I was a part of that, actually, and so I know the deal well. And ultimately, the reason that it was not that fruitful for anyone is because of that exact reason. It's because the man in the field in Africa said, this is incredible. I didn't have to walk all the way to a MoneyGram station 50 miles up the road to get that Naira out. I got the USDC right here, but he can't buy a chicken with it. And that's still a problem. So the answer is there is no answer to the pure retail use case, right? The presumption always being that somebody's going to off-ramp. And the bet from Circle and USDC and other stablecoin groups is, at some point, the world will realize that this is just a more efficient way to conduct commerce, and I don't need to off-ramp at all. I can just walk into my local chicken farm and go buy that chicken with USDC. But that's a big ask, a big technological change. We're not there yet. So in the meantime, the retail use case continues to be stymied by exactly what you just said. It's slightly different at the corporate level. And I say slightly because even the world of corporates, if we're being honest with one another, is nowhere near ready to take 10% or 50%, let alone 100% of its balance sheet and say, you know what, this $1 billion of US dollars don't need to be here. Let's mint it into USDC. Let's just operate 100% on USDC. And that way we never need to off-ramp, never need to deal with Forex again. We'll pay our suppliers in it. That 100 million that got to Africa, we can just pay our supplier with that USDC. They're not doing that yet. There are some groups that are starting to flirt with it, but haven't yet executed on that. And the answer is, until they do, you're right. They're going to have to off-ramp into either a local currency, or they're going to have to find a supplier that accepts that currency, or they're going to have to decide, as some are, and I mean by that, I can count on 10 hands, to keep it in a pool in that subsidiary, in that local country, not off-ramp it, and then use it as the fungible asset that it is to then fund local operations, which themselves might not demand hard currency.
But that needs the entire supply chain to convert to it. But again, it's the same as everything that you described in terms of the actual interfacing is the same as any other currency. It's like my supplier in Nairobi might also not accept euros. And say, hey, look,
Correct.
Give me euros and pay me in dollars only.
Correct.
Right?
Which is why exactly. So the largest use case now, with respect to at least sort of global commerce, multinational corporates, right, is that of using it as an internal balance sheet mechanism. As an internal use.
Interesting.
At some point, markets will develop, people will develop, suppliers will develop, but we're not there.
So let's lean into that. Before though, I have one last question, Noah. So we are talking about transferring money so far. The main, not concern, but one of the critical aspects of all this, and that's why the payment industry is so massive, gigantic, I don't know what's the proper English here, is the cost of it. Like, transferring money is not cheap, especially when you transfer numerous amount of transactions with high or low volumes, however you phrase it. what's the fee of using this technology? If instead of passing by my 30 third parties, as you mentioned in the examples earlier, and using that distributed ledger instead, what's the cost of it?
Sure, yeah. So the costs are, the short answer is that there are things on chain, when you send a transaction on chain, that are called gas fees, so-called gas fees, which you can think of as just, you have to fill your car with a bit of gas to get across the highway, which is an effect. And they do range. Those themselves range dependent upon traffic. Right? So if you're sitting in traffic for a long time, you're going to be paying more gas to keep your car running. Same thing. So depending upon that, right? If you are looking at sending a transaction at a very high volume time, and you have to send it then, you may end up paying a gas fee that is not $2, it's $5 or $10 or $100. Traditionally, though, they tend to be quite low. They're a percent, tenth of a tenth. They're almost de minimis. That itself is a whole nother topic, and it's something that there are groups specifically working on, which are building sort of payment rails on top of the Bitcoin protocol, right? So that it's another world. But yeah, the short answer is you generally have the platform fees, right? In order to just access the platform that you're running as a business. And then you have those individual transactional fees. That said, those are still multiple fractions of the cost that you would pay to run a traditional fiat transaction.
Interesting. So it's not, if I think of a normal SEPA transfer, you pay between 1 and 5 euros maybe, or sometimes even a percentage fee, which is not ideal depending on the size of the company. But here we're talking about cents or even fractions of cents, basically.
That's right.
Okay.
That's right.
Or maybe I'm going to get a bit too nerdy.
Go for it.
Intrinsically, what is the cost of that? If all that's happening, and maybe because I can understand a bank fee, I can understand a SEPA fee. It's a company that is charging for a service, right? And then they have operating costs, they have technology that they're funding, they have people that's doing the transactions, they have all these kind of things. They want to keep the lights on, right? If what you're saying is I don't have a third party to manage if I'm doing this internally, and again, maybe this isn't relevant to treasurers, but I'm interested.
It's interesting.
What's the inherent cost of moving some lines of code on the internet?
Yeah, it's not high. It's not high.
That's why it's negligible.
Yeah, exactly. It's not the 1 to 3% to 10% or sometimes 40%, that you would normally pay. And again, there's no standards here, right? This is a world of many different groups building many different solutions and trying to compete on very different angles. But yeah, in general, sort of on the whole, it's you sometimes see like 70 to 90% reductions in cost to just to move the assets. That's again, this is one use case, which is kind of the how do we move money more cheaply, quickly, and less complex way. There are other use cases that are built on top of those, and some of them are, most of those are accretive to this conversation, but that's at least a simple answer there.
Mm-hmm. Super clear.
Amazing.
Treasury, bring us treasury, and to treasurers. Okay, I think we've given a good overview of. So if I could just summarize that, I guess. Well, I guess we've given the overview of what digital assets are, which are essentially any virtual representation or any online, let's say, for fundamentally representation of real fiat, which real fiat in essence is also just representation of other underlying assets, or at least used to be. And we think of it like that, right? Either way, whatever people are willing to take as payment counts as payment, right? So if you're willing to get paid in coffee cups, that's
absolutely.
So all of it's just built on everyone's ability to trust that.
Cowrie shells, I think, were the first traded currency, or cowrie shells.
Exactly, something like this, right? That's why even gold. Why does gold count? Because people give it value. It doesn't matter. So nothing in the world matters, and we should just do nothing. Anyway, point being. Digital assets is just a virtual representation of real assets, or what are considered as accepted assets generally. The digital asset in this format where we bring in crypto and what we refer to multiple times on chain is just using blockchain technology to transfer those digital assets in the same way that you would see numbers on your screen and someone else would see numbers on their screen. The underlying back end of that is what's different at the end of the day. Just like bank transfer would go through all the different payment rails that sure treasurers are very well aware of. We've talked about them before, you mentioned a few there. It would go through a different payment rail, which is just this distributed ledger, which is a bunch of computers connected to each other on the internet, all keeping track and of approving the money as it moves through, essentially. And the approve it isn't someone saying, hey, yes, go ahead. It's just a computer software saying, yes, this is still reconciling with everything else that I've gotten, right? Because otherwise it would be slower.
Yeah, well, so everything you say is correct with one exception. I mean, so even that is correct, yes. I mean, ultimately, there are nodes validating, to use the term, right? Nodes validating transactions. So you're correct. That is the approval of the transaction as it is locked in to the distributed ledger. I am only just pausing there because when I hear approval, I think about other approval, which is that, as you said, from the treasurer's standpoint, you have to approve the transaction happening in the first place. Yeah. So it's a little bit of a different approval, but I just want to clarify that can be two people, right? It could be just both of Guillaume and Hussam saying, we approve this movement of $100 out of the company, or it could be 59 of 60 people that have to sign off because you're moving $1 billion in between subsidiaries, whatever it is. So different set of approvals than the node validators, but yes.
So what is the node validator approval? What is that?
So that is, you summarize that very well. You have a set of globally distributed computing systems that are basically running the proofs in a distributed fashion, which over and over again prove the validity of the transaction. After a certain point, you have global acceptance of that by the nodes, and then that transaction is locked into the chain. So,
I think that's how we need to say it to treasurers. It's a payment rail. It's just another payment rail that has its advantages over the other traditional payment rails.
It is another payment rail, and though you haven't quite asked the question, so I won't answer it. We can get into it when you ask it, but yes, it is and therein lies what I refer to at least as sort of the sea change versus the step change theory, which is that you, in effect, with ELT, distributed ledger, and crypto assets or digital assets, you've combined more than just a payment rail, because now you actually have an asset that is being used as a payment rail. So you've got payment rails, an asset, and you can form a currency on the back of that. So you sort of create an ecosystem in and of itself versus just the Swift payment rail alone. But again, you haven't asked that question, so I won't.
Yeah, I think that starts going even more complex. So the way I think of it is like, if you put a bag of gold on the internet and moved the gold around, as opposed to...
It's a very, very good analogy, yes, because yes, you're still moving an asset from, we can stick with the original example, Acme Corp, Guillaume, Hussam, two sides of the ocean. I'm sending you the bag of gold, just paid you, great. As it happens, if you decide to not take that gold, Guillaume, and sell it, let's say, I'm just going to hold this because, there's an Indian holiday coming up. And I know that with Indian holidays, the price of gold spikes, and I think this asset may appreciate. Yes, it was a form of payment. Yes, it was a form of currency because it was sent between you two, but now it's an appreciating asset as well. So
now we start to get speculative, which treasurers don't like. So maybe we stay away from that for now.
And so maybe to just validate the term, it's not a payment rail; it's a better payment rail. Oh. Would that be summarizing it well, Noah? Basically,
bearer or better?
Better. What did you understand?
Well, so it's interesting, the French translation here. So it is a better payment rail.
Voila.
But if you think about the term, which used to, so from the world of finance, you used to have something called bearer bonds. Meaning the owner of the bond owned the bond, right? It didn't really matter if there was a bank. You have it, like cash, right? By that, maybe you were saying it's a bearer.
That's exactly what I meant. Actually, I wanted to mean both in one word. That's right.
So,
nailing the digital asset world.
Both fairer payment rail and a better payment rail. Yes, correct.
Amazing. Absolutely perfect. Perfect. Noah, take us through how digital asset can transform treasury, or even how they are already transforming treasury. So maybe to begin simple, what are typical operations that can be supported, if not fully powered, by digital asset? And I think you took the example of the balance sheet earlier, something that would appeal to treasury. We can start there, but like, what are traditional example of things that could be enabled by digital assets in treasury?
Sure. So yes, and the simplest and probably the most well-known example of how you would use a digital asset in balance sheet, or a treasurer would use that, is MicroStrategy, which is the largest holder of Bitcoin in the world, and is also a United States listed corporation, which has decided to transform its theretofore US dollars into Bitcoin, and now sits on a Bitcoin position on balance sheet, which many, many, many times dwarfs its dollar holdings. So you have a company that admittedly is a bit of a one-off. It's been followed a little bit by the likes of the Teslas of the world, and the blocks of the world, right? But that's the big example. It's done it to such an outsized effect that it's almost, it's a long tail example now, but it is still an example. It's publicly traded, has to file earnings every single quarter, just like any other group, the SEC. And it has about $6 billion worth of Bitcoin on its balance sheet. This is a company that does about 150 million a year in revenues. So you can get a sense, right? What is the use case there? It's a treasury use case, pure treasury, as we would call it, not in the sense of I am a treasurer, but in the sense of I am holding a treasury worth of assets for my shareholders. And in this case, I believe that the US dollar will become deflated out of existence, or deflated to mean nothing, or not appreciate at the level that we needed to keep track with inflation. So I am instead taking our public shareholders' money and investing it in this asset called Bitcoin. That's an extreme example, but it's a real one. It's a valid one. Mm-hmm. And the company's done quite well in making itself very public in doing that. So that's one use case that does not need to be done to the extreme, at that level of extreme. Very simple, really. Just buy it, hold it, and let it appreciate.
Okay. So to jump on that example, Noah, because I mean, I can hear what the typical and doing his job correctly corporate treasurer would say here. Treasurers are the custodian of cash. The top priorities when it comes to investing, although I understand it's not short-term investment here, it's about balance sheet. But like if we apply the principle of capital safety, liquidity, and yield, most would argue and say that, okay, but the value of the Bitcoin is very much fluctuating, is very volatile, which can be a strength, weakness, whatever. But when it comes to treasury, one could say, do I want to sit on such a volatile asset in my balance sheet?
Yeah, it's a great question. So again, I am not as smart as Michael Saylor. I do not have a PhD from MIT, so I can't really challenge his intellect. Would I put 100% of my own balance sheet in Bitcoin? No. And I work for a Bitcoin company. Would I put 10% of it in? Yes. For the simple reasons that I was trained on. I came from the world of private wealth, private banking, when you always diversify your assets. And yes, you want some bonds. Yes, you want some long-term, equities and growth equities and emerging market equities, but you also want some highly appreciating assets that can be a rocket engine on your portfolio. So yes, I would consider it for a smaller percentage. And for those same treasurers, would say any diversification is good diversification as long as it's well managed. I'm presuming that's somewhat his argument, the cash reserve for daily operations and the like.
Fair. Okay. Go ahead, man.
So you didn't mention that's not treasury operation. You're talking about investing money for.
That you're correct. The term treasury operations is bandied about a lot. It's almost hackneyed at this point. Mm-hmm. That is a treasury operation in the sense that some treasurers operated to buy Bitcoin and stuck it in their treasury. It's not your traditional treasury operations, right? So very good point and very good segue. Thank you, Sam. So yes, on the other end of the spectrum of use cases, you have what I would call, and what I think we would all call, true treasury operations, which is your day-to-day running of the business. That to me is the true treasury operator. We get the cash that we have to the places we need it to get. How do we collect the cash we need to collect? How do we pay it out? How do we make sure that everybody can get paid? Lights are on, etc. So that's the other side. And we actually usually simplify, at least in my company, those two use cases. Simple. And then anything in between, because you can obviously mix them. So that side is, we have a balance sheet. We have an income statement. We're taking in receivables. We owe payables. We owe money to suppliers. We've got some loans out. We need to pay our employees, and we need to pay the electric company. And we're selling things, receiving money. Maybe we're just doing that in the United States or just France. But most of the companies we speak with are doing it all around the world. And so they've got anywhere from, say, 60 to 170 subsidiaries globally, which are all separate and distinct legal sub-entities of the parent corp. Admittedly doing the same thing. Still one balance sheet, still one income statement, still cash. Many orders of magnitude higher, obviously. Those are the treasury operations that we are most focused on and that we believe are where your most and maximal efficiency gains are to be had. Yes, you can. I mean, again, the MicroStrategy stock has done quite well. It's hard to parse why. Its customer base has grown, but not excessively. And yet its stock multiples and earnings per share have gone up almost exponentially. So whatever that is, we'll call it speculative for now. These treasury operations in the most broad sense are where we believe and where we hear and where we engage with the treasurer today that are using the platform. So what is it? I'm the CFO and I need to get $1 million out to 20 people all around the world. I am waiting on payments in from groups, and they may have 90-day AR cycles. I have an 18-hour window on settlements with my bank. So even me being paid from the bank takes 18 hours. And if it's a weekend, forget about it. That's 52, 60 hours. All of these are not just obviously time drags. They're costly, as we talked about, and they add layers of complexity to every single balance sheet operation. That is where we see the most day-to-day practical benefits to the treasurer. And there are many, of course, sub-use cases within that, but I'll...
Yeah. Understand. So the analogy I see here, Noah, is I think most treasurers understand the value in automating manual processes in general, right? So connecting your ERP to a TMS instead of downloading extracts from your ERP and then putting them into Excel and then manipulating them to do your cash flow forecasting. And people understand that, I guess, right? They understand that it's less manual. They understand that you don't need a person doing it. It instantly happens. And then that gives you a lot of time savings. It also gives you some cost savings in eliminating manual processes that you hire someone to do. And it gives you the ability to have it all done much more accurately, for example, as well, and avoid mistakes. And is there a good equivalence to draw here that for treasurers to use this payment rail is to eliminate the humans from the process and eliminate even the third party from the process, bank in this case, and bring it all onto an automated system, which is safe as well, because I think that's where people get a little bit concerned with their money not being in the hands of banks, because we perceive banks as safe, even though they fail as well. And we understand that it can all be automated. So I don't need someone in the bank to approve my transaction. If I've approved it and whatever my internal control processes, I can still move money internally or even externally with those that are on my payment rail. Is that a right way to sort of draw the equivalence?
Absolutely. Yeah, I mean, there's an element of automation to that, sure. But even I wouldn't say that that's necessarily that's not really a technological advancement, right? So to your point, what can be done by you and Guillaume as operators of your business, Acme, on your bank website can be automated just like we can do it on the Fortris UI, or anyone can.
Right.
It's true. You need to have APIs, right? That's helpful and it helps to speed business, but it's not the real step change necessarily. Your other points are, though, I do not need a banking institution of any kind, whether that's my direct or my indirect correspondence. I do not need the traditional payment rails. I do not need to wait for the weekend. And I do not need 50 reconciliation agents on either side of the ocean to handle all of these transactions. Most importantly, I don't need to worry about where is my cash? How long is it going to be until I get my cash? Did that wire that I just sent fail? Is it going to fail? Most likely it will fail. But if it does fail, it's going to fail on a Friday, because then my customer's not going to pay. And that's not good for me, because I myself am waiting for him to then pay me back. So it's a long chain, but that is where it is. I was speaking fairly recently to the head of blockchain for Amazon. And he said essentially to me, cost savings are not where we would dive into digital assets, because we're Amazon. We can get the best wire rates in the world. We're not paying $40 for a wire, paying $250 or whatever.
No.
Speed, maybe. But we also have our best people at the best banks doing this, because we're Amazon. And of course they're not going to. Where is the real value to us in this? And his answer was, it is that the money and the message travel at exactly the same time, which means that there is nobody on either side of the business guessing about anything, which means we no longer have to take out a futures contract based on the $1 million hole on the asset side of our balance sheet T-chart, because it's out and we don't know if it's coming back in 18 hours, and go to pay a third-party finance provider for the hedge, which is on the U.S. currency, which is now pricing up against. It goes on and on and on and on. That's the one message that we heard and that we've seen is consistent throughout. That is the step change versus, yeah, we can automate your processes, because yes, we can do that, but it's not the real
simplification. Simplification of all the other treasury operations you need to support a transaction, not just the transaction itself.
But the entire balance sheet application.
And I mean, one very pressing issue, problematic that treasurers encounter is cut-off times and time zone concern. And you just said it, that solves that, which is in itself it's a huge upgrade. If you don't have to, okay, I need to make my transaction for my FX before 3 p.m. because Australia is closing, or as you said, I can transfer the money in the weekend because that's the 15th or the 30th of the month is exactly on that day, and that helps the settlement and manage your cash more efficiently rather than losing 2 days of value time. That's huge.
I can tell you, to bring it back to the example of us three, if I choose to be paid in fiat, I send a note to the company, goes through a couple different banks, goes through Singapore where our financing arm is. I get an email from a bank in Singapore that says, we recorded this transaction, we'll send you the wire. Hopefully it's not a Friday, because then it's Tuesday. If it's Tuesday, then maybe it's Thursday, 3 days later, and it shows the dollars. If I choose to be paid in Bitcoin, I ping our CFO, and 3 seconds later, I'm paid. So it's a small use case. It's a small example, right? A retail level example, but it's extrapolated many times over. Again, these are the high level sort of practical use, applications. There are use cases beneath these that are very specific that we haven't talked about, but again, I don't know that we'll have the time.
So give us one. One that was
let's dive into it.
Interesting for you now. Give us one really interesting use case for treasurers. I really want to focus on treasury, not for speculation or monetary gain.
Sure. Okay. Fine.
So really on treasury operations. Yeah.
It's always good to use a practical verse. Okay. So the example which is most ubiquitous and which every treasurer of a corporate over a certain size will automatically understand is that of the trapped cash problem. This is a much more ubiquitous problem than even I understood back in business school. It's a much more ubiquitous problem I understood when I was in banking itself, in a payments, fintech. It is something to the tune of about $40 billion globally for multinationals is their cash stuck in places that it shouldn't be and that they can't get it out. So at the risk of over-indexing to it, I think there's benefit in speaking about it because it's extremely practical. So what is it? I'll take one company, one use case. Obviously, we can't use names, but it's a large U.S. listed Fortune 500 company that has something to the tune of about $100 million trapped in Argentina. Why can it not get it out? Because Argentina, like many other regions around the world, including Sri Lanka, Philippines, China, Nigeria, India, you name it, have placed varying levels of capital controls or currency controls in their respective jurisdictions. And that means that if you are a multinational and you are earning dollars or pesos or renminbi in those regions, you're stuck. And so these groups are essentially doing a bunch of different things. None of them work. Most of them are just losing 50 cents on the dollar or buying local shops to recycle cash through. It's really quite problematic. One of the things that we have done a lot and continue to do, and I think will be doing more, is to simply facilitate the transaction that allows these groups to pull their cash back to headquarters. That's it. Should be simple, should be able to be done, but it's not. And it's not anything that's ultra complicated. It just so happens that using the distributed ledger, using digital assets, you are able to both be in every jurisdiction everywhere. It's a technology ultimately. And you're able to stay within the legal realms of what governments require, which is do not pull dollars out of our economy. Don't need to do that. And you can do it for a time and a cost and a price and a level of complexity that is quite beneficial. So again, it's a specific use case, but it is a treasury operation. It's something that treasurers the world around spend a lot of time, money, and cost.
So why is it not done? Because not only is that a good example, that solves a huge problem, which is, well, I'm sitting on probably multiple hundreds of millions of dollars equivalent that I cannot do anything of. Why is it not done?
So it is done. It is done, but it is done at the margins, right? We've done this my own group has done this to the tune of almost $1 billion. We have not done it with listed Fortune 500 corporates, right? Or CAC 40s or FTSE 100s. We are very close to, and I think we will end up doing it. But the answer is, apropos to the beginning of our conversation today, every one of these groups has a board. Every one of them has a risk team. Every one of them has a legal team.
Yes.
And they all want to do what?
Ledger? What?
Yeah. It's a process of really ice breaking. I often think of us as an icebreaker, right? We're just slowly cracking through and learning a lot as we're doing it. But yeah, I mean, it's a true example of bringing the technology to a place where it has not been before, and then providing the education, the resources, and the trust through groups primarily, right? There's a reason we partner with the Big Four and Accenture and you name it, Chainalysis. So we often, this would be my own group, refer to ourselves as consultants, even though we are not, right? We are a technology platform, a SaaS platform, pure tech. But the conversations that we have over and over again are that of a consultancy by definition, i.e., we end up speaking with treasurers all the time. We end up speaking with CFOs, heads of cash management. And though the conversations are largely the same, the questions are manifold. And the questions have to do with, I, the treasurer, I, the cash manager, can now see why this solution makes sense. I can understand why this would simplify my life and help the company's balance sheet and help the cash positions. But I need to be able to now go convince my board and my legal team and my risk team and my operations team that this is actually something that is not only legal, it's something that is safe, it's something that is secure, it's something that has been vetted. And the way that we do that is a number of different ways, but the first and foremost is we partner with groups in the market like the Big Four, specifically Deloitte, like groups like Accenture that have quite a long history of working with different technological implementations. We work with groups like Chainalysis that are able to basically source the origin of any digital asset to where it is today. We do this because we can then say to that CFO and say to that head of treasury and say to that head of cash management, we can tell you, but you can also just go refer to this group, and this group can answer all these questions for you. So it's really a process of education, a little bit of evangelism, and really just a process of trust building is where we are and how we, I think, have made the strides that we have.
Let me play devil's advocate of the treasury. If I heard that, what would I think? First thing I would hear is, do you want to do what? I would hear and I'd say, what if the money devalues by the time it gets to me? But I guess the answer is instant. So the devaluation risk is...
Yeah, good question. So two answers there. And I get that all the time. So the first one is, well, you can simply run the transaction using, as we talked about earlier, a stable coin or digital dollar, in which case you have no volatility, right? Less arguably than were you to run it in, a pure Forex. The other one is if you are a believer in the value of, say, Bitcoin as a protocol and as an asset over, say, a stable coin, right? Something that is a stable asset, but that is owned ultimately by a private corporation versus a true decentralized asset like Bitcoin. You can, for the time that you will need to, which we generally estimate to be about 3 hours in total. If you want to run a transaction, let's use the same 100 million USD equivalent out of Argentina back to the US, you can simply work with another one of our partners, which is a tail risk and a hedging group, and just take that 3 hours of Bitcoin volatility right off your balance sheet for a small fee, right? Just like you would hedge any Forex currency transaction. So those are the two answers, and they seem to suffice.
Well, I was really at the legal point. I think when we first talked about it, and we mentioned your finance, right? The first thing I said to you is that even legal? So talk to the legality of this.
Absolutely, yeah. So we are working specifically with a group right now, not working with, but we have retained a group called Perkins Coie, and specifically their digital asset lead attorney, a fellow named Dax, who's been in the world of digital assets law for about 15 years. And we've retained them both because he's a great person and very knowledgeable in the space, but also because they are the in-house legal partner for Deloitte itself. And we've retained him to basically run through this entirety of the Fortris structure, of the Fortris technology stack, and then most importantly, of Fortris's partners and these flows to say, yes, this is a legal operation. Yes, this has been vetted by a right and upstanding law firm. And yes, you can, as any business, operate on using this technology. The only, we're very clear with the groups that we have been approached multiple times who say, we've got the same problem, but our assets are stuck in Egypt. And we say, well, we can't help you, unfortunately, because the government of Egypt has actually stated explicitly that cryptocurrency is illegal within the boundaries of Egypt. And so we say that can't operate there. We can help you, but not until they change that statute. So otherwise, yes, we have that opinion and it's there at the law firm and waiting for, to your point, Hussam, when the legal team says, whoa. And we say, no, that's okay. You can just go call Perkins.
So you have the lawyers involved and you got the Deloitte consultants involved.
We've got the lawyers involved, we've got the tax accountants involved, we've got everyone. It looks, when you really break it down to the corporate and then say a subsidiary, inter-subsidiary transaction, it looks almost exactly from a tax and an accounting perspective, just like a Forex transaction, meaning that you have assets sitting in a pool of currency locally. You move those assets just like you would in a Forex transaction. There may have been price movement or volatility from one currency to another. That may have incurred capital gains, short, long term. That may have incurred tax fees, whatever. And then your asset may be priced differently when it hits headquarters. But other than that, the structure and the path look broadly the same.
Okay, interesting. And then I guess you apply the same transfer pricing rules broadly as you would to a normal transfer of fiat currencies, applying this FX difference.
Exactly.
Makes lots of sense. No, I want to know what you guys are doing at Fortris, but before that, anything else you'd like to highlight about digital assets, how they can help treasurers, the problem with the trapped cash, or any other very relevant example that you think could help, well, educate us to begin with, me definitely, and our audience on the use of digital assets in treasury?
I do think there's an interesting use case which speaks to both ends of the spectrum that we talked about, which would be the pure treasury kind of MicroStrategy play. We just want to sit on an asset that grows. And the treasury operations play, which is, no, we actually want to use this for global balance sheet ops. And the example is one that is not just theoretical, it's practical, it's anecdotal. I worked with two large groups on it. And it's a very ubiquitous concept in sort of the world of balance sheets and multinationals. The concept is just escrow of any kind, right? Which in just simple legal terms is somebody is holding somebody else's money for a period of time in a safe environment, right? If you think about the nature of corporations, and the simplest example I can use is the example of, I think it's called Vrbo, which is the sort of vacation rental platform within Expedia. So Vrbo is one of the platforms. And it's the one that is based on a longer-term rental, longer-term future rental, right? These are not your $300 hotel stays. These are $10,000 vacations. In order to book these, you have to pay, as a consumer, you and Wissam has to pay, say, $5,000 to $10,000 up front. Where does that money go, right? Because it's only 3 months later when you pay the other $5,000 after vacation is over and the owner is paid after Expedia takes its nice little cut. That $5,000 sits in a bank account within Expedia's infrastructure and sits there not earning any money. It sits there incurring all of the operational fees and expenses in order to move it. And, Expedia works with a lot of people, as you guys know. And so that $5,000 quickly turns to multiple billions of dollars, right? So what is the use case? The use case is that money is just sitting there. That money can be either taken in at source or just minted in that wallet, be held in a digital asset. And instead of being a cost center to the corporate, it can be a profit center. Be something where low-level yield is overlaid. It can be something that's used as there's many, many different uses to this type of asset. And you see it all over the place, right? Starbucks creating its own stable coin effectively by having same use case over and over. And the bridge there, of course, between the treasury and the treasury operations use case is, well, if you are so minded and if you are looking for a way to more fluidly and quickly and cheaply and less operational complexity move assets around your corporate, a fantastic example, and it mimics the day-to-day treasury operations that you are running on a day-to-day basis today.
So to put a very treasury-related topic on top of that, it's trade finance. That's the trade finance complexity. When you need to issue a guarantee in order to obtain a project, and whether it's a performance guarantee or anything else, that's exactly the use case that you're describing here.
That is exactly the use case, Guillaume. And yes, I came from ABN AMRO's collateral commodities desk where we trade finance all the time. And yes, that is a perfect use case. Absolutely.
Amazing.
Very nice. No, I think I learned a lot for sure. I think we both learned a lot.
100%.
I learned a lot as well. But the reason you know so much is because you come from a company called Fortris. So please tell us, what is Fortris? What is your mission?
Sure. Yeah. So Fortris is basically the treasury operations engine that sits behind a lot of what we've talked about today, i.e., if you are a business, if you're a corporate, if you're a multinational, if you're a neobank, you have cash coming in and out of the organization, and you are trying to run your balance sheet, your income statement on a day-to-day basis, and walking through some or all of the things we talked about today. Fortris takes a look at that from the lens of the distributed ledger, from the lens of digital assets, and from the lens of the treasurer, which is to say, how do you most effectively combine all of these? At heart, very simple technology, just a set of multi-signature wallets and payment gateways in between those wallets, governance and control systems on top of them, and all of the data that comes out of all of that being fed out into the names you've heard us talk about today, like SAP, Oracle, NetSuite, Kyriba, right? It's a treasury operations engine meant to facilitate global business at scale, at speed, and with a almost complete erasure of operational complexity. That is the platform.
So can you break down the services that you provide, treasury services specifically?
Yeah. So the way that we talk about, the way I talk about it with CFOs is essentially, we are an ecosystem, right? We're a technology provider, but we're an ecosystem. You've heard us heard me talk about the names today. The technology itself is malleable to the operations of treasury, meaning that not every group has a trapped cash problem. Not every group has a cross-border payments problem. Not every group needs to do liquidity pooling or subsidiary funding, right? Most of them do. But in the end of the day, we are the technology that basically allows the CFO to say, I have pain points in my balance sheet. I have pain points in my cash flow. This is where they are. Let's try running those transactions on chain and see if we can solve those problems. That is the way we look at it, is we're sort of an umbrella SaaS platform you can overlay on the treasury, find out where it's hurting most, where it's costing most, where it's slowest, and we can solve those problems specifically.
And how do you integrate into the treasurer's landscape? Do you connect to the TMS? Is it a separate platform? How does it work exactly?
Yeah, we do. So that's part of our ecosystem, if you will, right? It's part of our sort of offer to the CFO and to the board and to the legal team and to the risk team, the finance team, the operations team, treasurers specifically, which is, you don't need to be a digital asset master. You don't need to understand what on-chain DLT and FIPS 2240. You don't need to understand any of that. Really what we're doing is we are helping you to have access into a system that will be very familiar to you, in the sense that you walk in, Mr. and Mrs. CFO, to your desk, you open up SAP, you open up Oracle, you open up Kyriba, FIS, you name it. Here's my $1 billion in cash. I've got 100 million in euro. I've got 100 million in renminbi, 100 million pounds, dollars, and there's my 100 million in Bitcoin. I need to do XYZ transactions today, and this is how I'm going to do it most efficiently. So it's almost a message of comfort, simplicity, ease, which is to say that we don't want you to, and we would not advise you to change any of your daily enterprise systems. We will feed into those systems to make it seem like it is your daily, regular operating functions, and basically take away that complexity, abstract it away for you, so that you can just have the benefits without all of the weight of having to be a Bitcoin maxi or crypto.
Absolutely awesome. Noah, thank you so much. And special note, I learned a ton. So really, really appreciate it. Thanks a lot for that.
Fantastic. Yes, it's been a real pleasure. Yes, real pleasure.
Anything you'd like to add on any of the topics we've touched upon? Fortris, trapped cash, digital assets, or did we cover it all? Well, I suspect not all, but
Yeah,
enough.
I think we covered the fundamentals. Certainly, if anybody has any questions, they can send me a note at Noah Fortris. But yes, no, it's been a real pleasure, a very, very interesting walkthrough. And yes, because we are at the forefront of this space, we learn a lot every day, even though we're deep within it. And so the process of just sharing use cases and sharing education and sharing out what are we hearing is something that we do all the time, even to groups that we are not working with yet. So always welcome a conversation with anyone about it. And no, otherwise, I think it's been a fantastic walkthrough.
Amazing. We'll put all the links in the description, your contact details, especially LinkedIn, and of course, all the links towards Fortris and what you guys do. Noah, thank you so much.
Thank you both.